Hello, everyone, and thank you for attending today's webinar. Don't call it a comeback. Emerging markets growth will power the return of commodities. I'm Sumit Roy of ETF.com, and I'll be your moderator for today's webinar. Before we begin, we wanted to cover a few housekeeping items. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. If you can't see the widget by any chance, please hit refresh on your browser. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. We do capture all questions. You can expand your slides area by clicking on the maximize icon on the top right of the slide area, or by dragging the bottom right corner of the slide area. If you have any technical difficulty, please click on the Help widget. It has a question mark icon and covers common technicals. An on-demand version of the webcast will be available approximately 1 day after the webcast and can be accessed using the same audience link that was sent to you earlier. So on to our webinar, which is sponsored and hosted by CSOP Asset Management, JP Morgan Asset Management, and WisdomTree. By now, everyone is well aware of the plunge that's taken place both in commodities and emerging markets during the last few years, and especially during the past year. From oil to gold to tin to iron ore, and from China to Brazil to Russia, we've seen a broad-based downturn take shape. Is the downturn in emerging markets causing the plunge in commodities? Or conversely, like some people say, is the plunge in commodities helping to fuel the downturn in emerging markets? And in either case, is there more downside to come, or is this a buying opportunity? These are the types of questions we will tackle today. Here to present today's webinar are Jonathan Citrin, founder of Citrin Group, an advisory practice of Ameriprise Financial, Sheffel Jr., Principal and Co-Portfolio Manager for Wilbank, Smith & Thomas Asset Management. We'll start with 2 presentations from our experts before getting into a question and answer session later in the webinar. So without further ado, I'll turn it over to Jonathan to kick things off.
Sumit, thank you so much, and thank you everyone for being here and for having me. It's a real pleasure to be part of the week. And certainly I hope I have a lot to share with you guys today. My job, just so everybody is aware, is to cover the interplay between the two. Sumit mentioned both the emerging markets and commodities, which is driving which, what should we expect, and we're going to get into all that great stuff today. But to start us off, we want to make sure that everyone has a foundational understanding of what the heck we're talking about and how these markets really work. So thank you for having me. I'm going to just tell you a brief little bit about myself here, and that is that I started in this industry quite a while ago, and in 2004 started my own firm, and at the same time I started my speaking career. And I tell you that just for one reason, and that is that I have this dual mandate, and that is to do well for my clients, of course, which I think we all want to do, and we all want to be good investors, but more importantly, to educate an investing public. So I do hope that by the end of this we'll have some great questions from everybody, and looking forward to parlaying some great information your way. So let's jump in and let's talk a little bit about emerging markets first. I'm going to segment this into emerging markets on the one hand and then commodities on the other. It's been a good week so far. We're on the 3rd day of the presentations, so I'm assuming that everybody has a pretty good cursory understanding of emerging markets. I did throw up a definition here for you so that you could have it right in front of your face. And the 2 key parts of an emerging market is that liquidity in local debt and equity markets is starting to exist. It's starting to come on. And that's one very, very important quality to an emerging market. The other is the existence of some form of market exchange and regulatory body. As you probably know, as you look around the world, there are many different institutions that classify emerging markets differently. Generally, this is the best definition that I can give you, and in order for you to truly understand the attributes of what we're talking about. More importantly, and more to the point of what I'm going to discuss, is on the risk side, and we have greater risk due to several factors in emerging markets. political instability, domestic infrastructure, currency volatility, limited equity opportunities, as we've all probably run into here or there. Most interestingly is that I find, and I'll touch on this as we move on today, everyone, but emerging markets are just kind of remote from people. A lot of people don't have the opportunity to travel. A lot of people have never been to emerging markets. There's a language barrier. There's certainly cultural barriers. So we have these definition risks that I have up on the screen in front of you, but there's also other risks that we'll get into as well as we talk about emerging markets, commodities, and the interplay between them. What's interesting is that in the stock market, we tend to look in the stock market at a stock's price as being efficient if it reflects all relevant public information. So if you look at a stock that's trading on an exchange and you see it's priced at $26 a share, that price supposedly in an efficient market it reflects every bit of information that's publicly available. The reason I bring that up is because emerging markets are pretty far from that. Emerging markets are very inefficient for some of the reasons that are listed here on the screen in front of you. I do believe, which I think is very, very important to understand today, that money is this very powerful way of looking at the world. Money, if you think about it for just a few minutes, money is a language that just about everyone speaks. Unless you live in a remote corner, you're maybe a monk or someone who lives off the land, you know the language of money. And so when we look at emerging markets, what we're really asking ourselves is, what are the markets telling us about these countries? Because there are all these different layers of risk. And moreover, is what they're telling us true? Is what they're telling us actually efficient? So there are very many factors that play into emerging markets and the outlook for emerging markets, not the least of which is how many various emerging markets there are. I threw a few up here: China, India, Indonesia, South Africa, Israel, Malaysia, Russia. I'm not going to list them all for you here, and again, most people on this call will never have visited Malaysia or never have visited India or the Philippines or Hungary. It's certainly a barrier. One thing that's very interesting that I think people don't recognize when we're talking about is the cultural differences that happen between various markets around the world. So we're trying to figure out if there is a causal link between emerging markets and commodities. And what I need you to understand is that there is so much going on underneath the surface, some of it, again, being cultural. So let me give you an example. I'll give you a developed market example. If you go to France, and in France, you are invited to an investment meeting. If you show up on time to that investment meeting, that's seen as being rude. Culturally in France, you need to show up late. Late is on time in France. If you move a few doors down to Germany, it's the exact opposite. And that's a real easy example. But I think when you're looking at these countries and trying to discern where are we
It seems like we lost John there on the call, so we'll check with him and see if he can dial back in.
I'm not sure what happened, guys. I'm back, though. Is everyone still with me?
Yeah, we hear you now, John. Go ahead.
I don't know what happened. I was talking. I could hear you. You couldn't hear me. I don't know if it was on my end or not, but I was just starting to have fun. So if it's okay with you, I'll jump right back in.
Sounds
Great.
good. Sounds good.
Okay. So what I have in front of you here, guys, is this map of the world. And what I want everyone to start thinking about is I want you to start thinking even more broadly when you think about emerging markets. I want you to think of the consequences of various differences and various changes in these markets around the world. I want you to recognize how broadly we're speaking. I want you to look at that light blue on the map and recognize that that light blue constitutes, at least geographically, a larger portion of the world than possibly even the domestic markets. So we're talking emerging markets, and my first goal is to really get you to understand a little bit more about perspective of these markets. And I'm gonna give you a little more help here. And I pulled up from a great source some statistics on emerging markets for everyone to contemplate. I sorted these by the column on the right hand, which is your population. And you can see China is the most populous country, India being the second. What's fascinating is if you look from the list from top down in emerging markets, what you recognize is, from this list, that the majority, 3/4 of the most populous countries in the world are all emerging markets. And that starts to paint the picture for you. That begins to show you why it's so important to understand the interplay between emerging markets when you're talking about commodities. Because we're talking about the most populous areas of the world that drive consumption and in a lot of cases are involved in the majority of production. So this is a really important slide for you to understand, and I want you to get how vastly important it is to know your ins and outs when it's coming to emerging markets, because this is not anymore 1980 when emerging markets was something very new and the MSCI EAFE index had only started 10 years earlier. We are now in 2015, and emerging markets are something to understand with depth, with tremendous depth. I would be remiss on this call if I didn't talk just a little bit about the ups and downs of these markets. I now sorted that same list, but by GDP year over year. This is a huge factor that people are looking at economically, and I want you to put that in the back of your head for a second, the economics of emerging markets. India being the highest returning year-over-year GDP out of any country that we track. And certainly the lowest on the list is also an emerging market, which is Brazil. We all know Brazil's been having quite a tremendous amount of difficulty themselves. So we've got return, we've got risk, we've got emerging markets that make up the majority of the world, and we also have emerging markets that are the top and the bottom performers. So the last part I want to really mention when it comes to emerging markets is the idea of risk and return, what's historically called the risk-return trade-off. And I don't think it holds course as much as you think in emerging markets. In a typical market, we might say, oh, that has a return of 9 and a risk of 18. Let's say risk is standard deviation. And we would look along this frontier and pick the asset that has a higher return for lower risk. But what happens is this isn't factually the case in emerging markets. In emerging markets, risk isn't a number. Risk isn't something that you can just assess by looking at some statistics. Risk is not something that you can get by quickly looking at figures like I just showed you. Risk is something much greater. And I want to give you a quote that I think is really pertinent. This is a quote from Ian Bremmer. If you don't know Ian Bremmer and you're into emerging markets, you really don't know emerging markets. So I would encourage you to start following Ian Bremmer along with some of his constituents who know these markets very well. Ian Bremmer came up with the idea of political risk in financial markets. So not too long ago, that wasn't something that we talked about. And he said that those countries where politics matter at least as much as economics for market outcomes are emerging markets. So think about that, at least as much, if not more. And I want you to really figure out here, as we massage our way into commodities themselves, I really want you to figure out that this is not about GDP. This emerging markets is not about GDP. It's not just about population. It's about geopolitical risk. It's about laws and rules and regulations. There's a tremendous amount of factors of causality that comes into play when we're talking about emerging markets. So, I think with that unfamiliarity comes a lot of headline risk, but also a tremendous amount of portfolio risk if you don't know what you're doing. So that is my summation for emerging markets. I'm going to jump into commodities now, and we're going to talk a little bit more about commodities, and we'll come back to this idea of linking the two together in just a minute. I put up here, and you can certainly read it for yourself, a definition of commodities. The two words that I'm going to pull out here are interchangeable and uniform. So on the second line, the word interchangeable. On the last sentence is the quality of a given commodity may differ slightly, but it is essentially uniform across producers. That's key. Those words, interchangeable and uniform, are absolutely key when we're talking about commodities, and I'll get into that in just a minute. And I promise the meat is really coming here. A few examples for you. I think everybody knows what commodities truly are. I put on here currencies and indexes. It's arguable. Some people don't see those as part of commodities. I certainly do. Feel free to ask questions about that as we go. Some of the more popular commodities, two of the most popular ones that people look at, oil. We all know what's happened to oil over the last 12 months. This is a chart of what's happened to oil. It's been an interesting course. Probably the wicked stepsister or stepchild of everybody's portfolio, if they own it, is gold, because it's done so seemingly poorly performance-wise. And this brings us back to what Sumit was asking, which is, how do we determine what's going on between these markets? How do we know the differences between, the interplay between them? And I want you to start thinking for a little bit about that idea of an inefficient market, because in commodities, there's a different type of efficiency in commodities. In commodities, we're talking about that word that I mentioned before, that I highlighted for you, that parity, that uniformity, the interchangeability of commodities. And in the commodities world, 500 bushels of wheat in Iowa cost the same as 500 bushels of wheat in China. So we have this definitive efficiency and price across the world. When we're talking about money as a language of the world, as I presented to you earlier in emerging markets, it doesn't exist as severely in emerging markets, unless emerging markets are linked to, commodities are linked to emerging markets. And to give you some statistical feel here, take a look at the correlations over a common period for assets around the world, equities and commodities. What you'll find, that big green clump of on the top left, is your correlations, with one being perfectly correlated, negative one being perfectly negatively correlated, and zero being uncorrelated. So you see that even emerging markets themselves are very highly correlated with other equities around the world. And you start to see, as we reach out in some of these other areas like gold and crude oil and the US dollar, what we start to see is we start to recognize that there is some negative correlation as well. So to the question that we're trying to answer of this interplay between the two, it's very important to recognize that even though these vastly populous countries around the world that are growing at a much quicker pace than in the developed world, even though they consume and produce a tremendous amount of commodities, commodities can also have a negative correlation to those markets. So some commodities can act in opposition, which I think is really, really quite fascinating. But the point that I want you to take away from my initial comments here today is that commodities themselves, from a price purchasing power parity perspective, tend to be fairly efficient across markets. The same cost for gold in one country versus the other. But when you add in the geopolitical risk, when you add in the unsystematic risk of emerging markets, you start to see the emergence of the interplay between the two. And I wrote down here for you that emerging markets brings unsystematic risk to the commodities world. And that's the idea that I want you to really drive into you today, is that I think it's a back and forth. Certainly one plays off the other, but more than anything, when we look at commodities and emerging markets and the interplay between them, you cannot look at commodities without looking at emerging markets. So I do want to thank you for the time here, and I'll be back in a little bit to talk a little bit more, but it's my time to pass things to Roger and let him jump in and give us a little bit of his insight.
Thank you, Jonathan. Move forward here to My name is Roger Shuffle, and I'm with WST Research. We are the research and asset management division of Wilbank Smith & Thomas. I'm going to dive a little bit deeper into some thoughts around commodities and emerging markets now that Jonathan has given us a good solid background. I think the summary here would be pause and transition. That's one thought that I would introduce and kind of keep in the front of your mind is pause and transition. At WST Research, we tie a lot of our thoughts and work with academic research, and I'm going to introduce you to a word today, deindustrialization, which is a word that's used heavily by Danny Roderick out of Harvard, and it's basically the transition from industry to service. And think about the United States, the transition that occurred here from a industry to service. So that's kind of where my pause and transition comes in. The slide that's in front of you, I'm going to talk a little bit about a couple topics on this slide. I think the first point to really pick up is, and I've highlighted in red, is the sea change in commodity returns really beginning into 2011. So keep that 2011 date in mind, and that'll tie into further conversation. Also, the weights at the top I think are important, specifically important if you're looking at investing in a broad commodity index, and you can see the energy influence there. Think of energy as the apple of the S&P 500. So when you're buying a broad commodity index, you're getting a large amount of energy input there. The next slide, continuing with that discussion around energy, is the battle for Chinese oil sales. I think this is a lot of what you're seeing going on specifically in relation to crude oil as it fits into the commodity and emerging market concept. Really what you're seeing here is that transition. In China, I would call it the deindustrialization, to start using that term. What you're seeing is a lack of demand for oil, and you're seeing a supply that's being held steady. Mainly, you could call it a defensive measure, according to this Bloomberg article, to defend against worldwide oversupply, specifically from the shale industry in the United States. I would say you could go back, if you did an article search, if you've looked out there, you'll find about the time the articles popped up on dropping the ban on the export is about the time you start to see some pressure on oil. So if you're looking at a commodity to watch in specific, oil would be interesting. The demand there is somewhat adaptable, and or should I say the supply there is somewhat adaptable and able to be driven in a short amount of time versus other areas of the commodity markets. Continuing with Jonathan's discussion around correlation, specifically looking at the correlation of broad emerging markets to commodities at about a 0.62. This is really picking up from that April 2011 point that I mentioned. And then you can see commodities are actually a little less correlated to the Chinese equity market than maybe the broad emerging markets equity market. But you do see, if you drop down one more box to the right, that there's a 0.7, so correlation to the industrial metals actually picks up versus China. It goes along a little bit with another theme in Danny Roderick's work about manufacturer exporters versus non-manufacturing exporters. So, and back to Jonathan's comments regarding commodities as an input. So are you a user of inputs and a producer of goods, or are you a producer of inputs, being commodities? Good way to, you can slice and dice some of the emerging markets. One point here, I show you the size of China versus, sort of the next largest emerging market by GDP, just to go along with the China theme as being a heavy influencer. So keep in mind my 2011 red numbers across the commodities spectrum. And what you're looking at here is the fall off in China as far as industrial production year over year, the fall off in China fixed asset investment growth. So in other words, are we producing, are we building, are we using particularly potentially steel as an input? I'll show you the next slide being basically the fall in the import of steel products. So continuing with that theme along the deindustrialization of China. Another theme introduced, and sort of the question here is, was the switch too soon? Is that causing some of the pain, or is the pain natural? The question there is you want to establish a strong wage base across your basically manufacturing salaries before you attempt to convert to a service economy. Ideally, it kind of makes sense. You want to have people who are able to afford goods and services. If you read some of Danny's work out there, what you'll find is that the emerging countries are leveling off at much lower wage bases than the sort of the level that occurred when what are now developing markets leveled off. So a little bit of an introduction there, a little bit of a tie-in to China and an attempt to link emerging markets with commodities. So in summary, you could attribute a lot of the commodity returns prior to those dates with a China ramp up, and basically they achieved in 10 years what the United States took 40 years as far as industrial output. So that's a little bit of our thoughts around this is, again, around that general theme of pause, transition, and watching for the success of it. If you look out there, the manufacturing data is slowing in China, but the services data is slowly picking up. So, and the question is, how long will that transitions take? If you use the sort of the same time frame and the same expedited time frame versus the U.S., you could be looking at several more years to complete that transition from a industrial nation to at least a balanced service and industrial nation. That's where I'm going to leave it off, and I'll turn it back over to Sumi.
Thank you, Roger. And thank you, Jonathan, for those presentations. Now we'll get into the Q&A portion of the webinar. I'll start by asking the questions, but we encourage the audience members to submit their own using the Q&A widget at the bottom of the screen. And if you can't see that widget by any chance, be sure to refresh your browser. We'll try to answer those questions later on. But why don't I start off by asking the first question to you, Jonathan. I know Roger gave us some figures on the correlation between commodities and emerging markets. But in your view, how correlated are commodities to emerging markets? We hear all sorts of news about how China's slowing day after day. They might fall below their 7% GDP growth target. And at the same time, we're seeing the commodities plunge, and it seems like there's a strong link between those two. Is that the case?
Sure.
So what's your view on that?
I think it's a wonderful question, of course, and thank you, Sumit, for teeing it up for me. I hope that what came across with my part of the presentation, and I agree with you, Roger really did a good job of getting a little bit more into the granular details, which we needed. What I was trying to do is to certainly answer that question en masse in a larger way, and I'll get more specific now, Sumit. So there definitely is a correlation between the two, and that's the point I was trying to make. I think that commodities have their own risks, but when you add the relationship of emerging markets and the rationale for why emerging markets are so important to the commodities markets, and vice versa to some extent, you start to really understand that there is a definitive correlation. The problem is there's a difference between correlation and causality. And I think this is a really important point. Obviously, I wouldn't say it if I didn't, but I want to just stop for a second and kind of highlight everybody to stop typing and give me your ear, because this is really, really important, and this is what we screw up the most. We mistake correlation for causality. And we do that for a number of reasons. And I'm going to give you a quick example, Sumit. There's something, when we analyze in our brains risk under uncertainty, and think about that term, risk under uncertainty. Is there ever a greater place with risk under uncertainty than in emerging markets? Maybe in frontier markets, but it'd be hard to argue that there's more risk under uncertainty in emerging markets. So what we do when we're looking at these markets is we try to substitute correlation for causality, and we try to get an idea of what's going to happen in the future. And we have these tricks that we play. So what happens a lot of times is in our brains we have these shortcuts that are called heuristics. One is called anchoring, and I'm going to throw one up here on a slide for you just so you can see what exactly I'm talking about, because when somebody discusses something that's a little bit foreign, the visual aid helps. So anchoring is one of these. And what anchoring is, everyone, it's relying too heavily on the first piece of information that's offered to you. This is a really valuable investment tip, particularly when it comes to looking at the correlations between emerging markets and commodities. So the easiest example I can give, and we're about 3 days from Black Friday, and it's the mall. Everybody goes to the mall, and there's a sweater that's $500, and it's marked down from $500 to $150. Well, that store just anchored you. They gave you a piece of information, $500, and then they dropped you down to $150, so you automatically think you're getting a good deal. Think about if that happened in an emerging market. Think about if you're buying commodities based on a projection of emerging markets, on a assumed causality in emerging markets. So if you either misunderstand correlation for causality or you don't understand causality in the first place, you're really in for trouble in emerging markets. So it's very important to understand how your thought process works when you're investing in emerging markets and commodities, because causation is not the same thing as correlation. Another one that I just wanted to touch on here is called availability. And this one has even more pertinence. This is the ease of examples in coming to your mind. So we're thinking in terms of correlations. There's definitively a correlation between emerging markets and commodities, but there is not causality that can be highly determined. But what our brains do, Sumit, is our brains look for the most recent thing we can find. So think about this. For example, China just had this big downturn a few months ago, and the government got involved, and people are nervous about China, and so we have this negative outlook potentially on commodities as well. Well, again, there is a correlation between the two, but not a causation, not causality. So I would tell you the answer to your question is there's a high correlation between them. I'm a big data-driven person. I can throw back up on the screen, mine or Roger's slides about correlation coefficients, and I think you can get an idea of how to invest in these markets based on what we do know. But the mistake would be to assume that there is causality, that we know that because of one thing happens, something else will definitely happen. So there is an interplay, but it's not as closely connected as people think. And this is a time when things are very tenuous in emerging markets that you should be very careful with how what you think is causality over correlation. I hope that's helpful, Sumit.
That is, Jonathan. Thank you. And then turning to you, Roger, Jonathan just talked about how we shouldn't read too much into the correlation between commodities and emerging markets that we see. What's your take on that? And also, I'd like to ask you, what countries do you look at when analyzing emerging markets and commodities together? Is China the key one, or are there other ones you keep an eye on as well?
I think you really have to divide the countries up, and I think a useful way to go about that slicing and dicing would be the manufacturers, the users of input, and then the producers of input to some extent. and that will give you some ideas as to commodities, the flow in and out and the usage. And again, I think as that old famous saying that a rising tide lifts all boats. So in a period maybe where the tide is out, you have to look around a little bit, for that specific boat that might be working. So I think you're diving into countries, you're diving into commodities in general, and you're probably moving somewhat away from broad indexes into specific countries and specific commodities. So, for instance, you might see a lift in oil, grain, softs, and livestock with regard to China on the other side, turning out a service-driven economy and less reliance on metals, for instance. So, just some general thoughts around commodities and emergings back to correlations. And correlations are great, but if you can't answer the question in your mind of why are these correlated, or if you ever take a number and you can't make sense of it, that's where you're going to end up on the wrong side of one of the heuristics that Jonathan was referring to. So that's my comment on that.
Agreed. Well said.
And then, Jonathan, obviously it's kind of interesting what we're seeing right now today. We're seeing basically every single commodity going down in tandem. It almost seems like we're seeing a bear market for the asset class as a whole. Is that unusual, or is this something we tend to see? I know a lot of people talked about a commodity super cycle when they were going up in the early 2000s, as if they were all going up together because of various booming demand we were seeing from emerging markets, and then also constraints on supply. Now, are we seeing the opposite, a commodity super bust or something like that? What's your take on that?
Yeah, it's fascinating. It's really fascinating to be an observer of markets and a participant, of course, and watch this play out, because I tell you, the last, 5-6 years, ever since 2008, it's been quite an interesting run in commodities. And I think of oil, recently, but I think of gold. And then, down the line, as you say, we're seeing mass sell-offs, we're seeing drops in prices. It's quite ubiquitous. I would tell you that, just as an aside, I have this weird thing about me where I think when things are kind of calm and easy, it's harder to know what to do. I think that when 2008 hit, at least for me, it was pretty easy to know what to do in 2008. And I think when there's things are flying high or there's blood on the street, we tend to really get confused at first by that emotion. But if people stop and breathe a little bit, I believe that there's actual clarity in these moments of extreme price movements, more so than there is in a more of a massaged sideways market. Now, to your question, commodities are always volatile. They're one of the most volatile asset classes out there, particularly if you're including currencies in that, because currencies, probably more so than any other asset class, are highly volatile. And this is not just opinion. I'm talking, using standard deviations to assess volatility on a relative basis. So you've got an asset class here, Sumit, that is already, we know it's volatile. And I would question our listeners as they're trying to contemplate what to do in commodities. Is this an unusual downturn or typical bear market in commodities? I would question them, are you looking at your desired outcome or realistic outcomes when it comes to commodities? Because I happen to think that, to answer your question very straightforward, I think this is a pretty typical event happening in commodities markets. It's, certainly down markets are not something to be feared, just like up markets are not something to be revered. And when we look at this market, it's really a question of, are commodities the main engine of your investment platform, or are they an additive to that investment platform? And if they're an additive and you've gotten into these, and I think this dials a little bit into what Roger was saying as well about knowing the numbers, and that is, you may have all these perfect plans for your commodities in your investment portfolio or your client's investment portfolio, and that may go awry. But you should know up front when you're getting into these that we can experience these long, extreme periods of down, most importantly because of how commodities interplay with other markets like emerging markets. We're not talking about an asset class in emerging markets that is easy to understand. We're not talking about an asset class that's void of risk. We're not talking about an asset class that is blue chip stocks. We're talking about something that is tremendously volatile and very, very risky and should be part of a larger platform of investing. And so I guess, my long answer being said now, my short answer, Sumit, is I think it's a pretty typical bear market, and that doesn't scare me away from it. I think that people should understand going in that commodities markets, because of the attributes and the linkage to emerging markets, commodities markets are going to have periods of significant long down trends, and that's going to happen. And sometimes it's going to be explainable through causality, and sometimes it's not. And you need to know what you're getting into. But I think I gave you both my long and my short answer. Unless you want the medium one, I'll stop there. But fascinating stuff. I think that this webinar attracted me so much because these two asset classes interplay with one another more than just about any other asset classes in the world. So it's a great thing. You can tell I like talking about it, but something for people to continue studying long after we hang up.
I think you're making a great point, Jonathan. Just because they're going down, I don't think investors should necessarily be fearful. In fact, maybe this could be the time to get in because prices are low. So Roger, do you think there are buying opportunities out there in commodities? I know you talked about liking oil. Which commodities exactly do you like right now in terms of adding to your portfolio because they've gotten so cheap?
So I wouldn't say that I'll backpedal on that one a little soon. I wouldn't say I like oil right now. I'm basically saying I think oil is a commodity that has a potential for a price rebound, and that I would attribute to the ability to adjust supply. I'll just keep it general, who you believe may be the swing supplier out there and who you may believe can control it. At some point in time, there would be some motivation just with regards to the design of the economy, with regards to the price of oil, that there would be some motivation to raise the price of oil. So I'm looking at oil from a guess you would call it a elastic standpoint, much more so than some of the other commodities where you may not be able to reverse supply as quick. So that was kind of my thought on oil. As far as other commodities out there, I think some of what you're seeing, just to go back to the bear market question, is I think what you're seeing is sort of round two of the fight against commodities. Round one might have been the deindustrialization of China, and round two is the dollar strength. If you look back to my slide, you'll see some pretty incredible dollar strength, and I'm just measuring that simply by UUP, the ETF. So if you look out, UUP is up today, EEM's down, DJP is down. So you're seeing some of the dollar battle against commodities.
Yeah,
now,
if I may, I'll just piggyback on
sure.
that for a second, if you don't mind. I think that Roger raises an excellent point, and again, as I mentioned earlier, there's whether or not we consider currencies a commodity, I don't think really matters in this current point. But today's world, if you think about it, there is something called the G0, which there is obviously everyone knows the G7 and the G20. Well, the G0 is a world where there's no major player that's setting the pace for the world. And I think in a discussion of emerging markets and commodities, it's important to present that as an idea. And I mean this to the answer to your question, and that is that there's really in today's world a lack of leadership, and I don't mean the lack of trying, but I mean a lack of people actually following. And if you think about all the countries around the world, everybody's in everybody else's pocket, and everybody is behind everybody else's back. And to look at commodities alone, like to look at oil and say, oil right now is a major buy. I just don't think that today's world is the type of world where you can make a single asset class prediction like that and feel confident about what you're doing. So I love Roger's answer because he's kind of he's very eloquently telling you that it's he thinks that there's an opportunity for a rebound, but whether or not it's a hard buy, and if I'm interpreting that right, Roger, but I just want to present that to everyone, that once you start to really read the language of money throughout the world, what you start to understand in today's world is we really are in a G0 climate. That's not my term, by the way, but we really are in this G0 climate, and it's hard to get a pulse for which direction we're going. And so if there's ever an asset class that I'm not going to pick a winner, it's going to be commodities. And I know that might seem a little anticlimactic, but I think that is climactic in its own right, and in saying that today's world is so interconnected and markets are so emotional based because everybody has access and information, that commodities and emerging markets are the area that you may want to be involved in for various reasons, but you also want to be very careful.
I think you make a good point, Jonathan. Unless you're a professional or you're a risk taker, it's probably not a good idea to pick individual commodities.
Well
at least for the average investor. With that said, how should an investor play commodities? Should they buy a broad basket of commodities, some type of commodity index? Should they use ETFs to do that? Do you have any take on that?
I do. I think, having cut my teeth now in this business over a number of years, it's been fascinating to watch the rise of ETFs in this world, and they've certainly been an additive, in my opinion, to opportunity for people to invest. It's not without complication, as we all know. There are different risks in different areas, but I think there are kind of two parts to that question. One is, should we be using ETFs, and the second is, should we be staying very broad and buying broad ETFs or very specific? And obviously, everyone who's on this call is going to have a different type of strategy, and some people are going to be passive investors, and some people are going to be active investors. I believe that if you want to, in your portfolio, to represent a hard asset in your portfolio, you want the most direct avenue to that, which would be an individual specific ETF. So there's your answer, right? But I also believe that there is a place for other securities and other vehicles and ways of doing this, depending on your individual circumstance. But I think that the advent of ETFs over the last, let's say, decade and a half has been a wonderful thing for investors, because now anyone can buy into gold and oil. It's also made markets a little more volatile than they probably used to be, but it's given people a lot of opportunity to diversify their portfolios.
And Roger, a similar question for you. How do you go about looking at commodities in terms of adding them to your portfolio? Do you agree that the broad-based approach is the better way to go?
From an asset allocation standpoint, and if you're focusing, in your core position and as a core asset allocation component, I would say some type of broad-based ETF would probably be the best way to go, given the complexity of creating anything else in a quote, I use the word, maybe the word's not correct, a retail type environment. It's from an institutional standpoint, experts on staff and a single fund to manage probably could look to other avenues for commodities, but I think an ETF, a broad-based ETF, is good. And are they all the same? I think you ought to do some research and some work on the index and the weights behind each different commodity, broad-based commodity index, and decide which one is most appropriate, and maybe model 3 or 4 basic portfolios with the different ETFs in there, and take a look and see if that can get you to the goal that you're looking for.
Hey, Sumit,
Great.
I just
and then,
also, go ahead.
Sure.
Sorry if you.
No, go ahead, Jonathan.
Well, I was just going to jump in and say, he raises a great point. And there are resources, one we know of really well because we're all logged into that website currently, but there are great resources out there for, right? I mean, there's your plug. You can pay me later, but there's no compensation. We should make that disclaimer. But there are great resources out there for understanding exchange-traded funds if that's your vehicle of choice. And I think, there's expense ratios and there's turnover ratios and there's, factors like contango and foreign currency effect. And certainly if you're working with a professional, even better, let them do the work, let them be the experts. I think that that investment managers are paid to make these decisions, and it's a good place to utilize them, but use the resources that are available to you because there are many factors, and not all ETFs are created the same. Even something with, I would call issuer risk. Are you more comfortable with company A or company C? Which one is more likely to be in business 10 years from now? Look at volume, tracking error. So I think Roger is very right. There's lots of ways to do this, and it's important to look under the hood. Especially, in
also
emerging
be aware
markets.
of.
Yeah.
Also be aware of the K1 and, the fact that there's potential you might be purchasing an ETN and, again, introducing the credit risk to the equation.
It's always fun when, we've talked about this offline, but it's always fun when you've got the mass, emotional volatility of emerging markets, and then you add commodities to that, and then you add contango to that. So, good luck to everybody, but I think it's very doable. It's very doable, and exchange-traded funds and other vehicles, even though we're talking about things to look for, these are a benefit to investors. I think I'd be remiss if I didn't say that investors have many more options these days, and I think it's a real positive thing. It's just, know what you're getting into is all we're saying.
Great. And then we have a couple minutes left. We got a comment from the audience directed at you, Roger. You talked about the deindustrialization that's going to happen in some of these emerging markets. This audience member said, though, isn't it the case that China still has a lot of industrialization that it has to do in the sense that a lot of people still need to move out of the rural areas and go into the cities, and there's a lot of infrastructure that still needs to be built out. So while perhaps they're trying to shift more towards a service-oriented economy, there's still a lot of infrastructure and industry build-out that has to happen. Would you agree with that?
I would agree with that, and I would offer a comment with regards to another topic I brought up about, was the deindustrialization too soon? I guess I could have added an additional slide that said, is the deindustrialization by choice? So this person is questioning, the further migration, basically the urbanization, and that would assume some migration into a plant. The problem you may have is, and I alluded to this, you may have wages topping out in China due to maybe an external factor. Let's throw maybe potential of Vietnam out there. So the question I'd bring up is, too soon, and was it by choice or not by choice? So I hope I answered that question. I do agree. There's tons of untapped potential, tons of additional people that could migrate to manufacturing that could later migrate out of manufacturing or up the manufacturing chain and have the opportunity to become great consumers. I mean, I make the joke with my clients occasionally that we were Europe's China, decades ago. So, we were the cheap labor source. We were moving to the cities. We were industrializing. We were manufacturing. We were later converting to service. So there's some analogy to be drawn there.
Thank you, Roger, and thank you, Jonathan, for your excellent insight in today's webinar. I'd also like to thank the audience for tuning in. We hope today's webinar was informative and helped shape your understanding of commodity markets as well as emerging markets and how the two are intertwined. Thanks as well to our sponsors for the week, CSOP Asset Management, JP Morgan Asset Management, and Wisdom Tree. Tune in tomorrow, Thursday, December 3rd, for our next webinar in this series, Emerging Market Debt, Accessing Yield, Understanding Risk, Controlling for Currency, which will take place at 11 a.m. Pacific Time, 2 p.m. Eastern Time. That concludes our webinar. Have a great day, everyone.